We've had a pretty volatile 2 years, but 2023 very strong across the board for leveraged credit. Leveraged loans as of now up almost 12.5%, after effectively a flat year in 2022. Most of that coming from the absolute yield. So, all loans are floating rate, and so the base rate at over 5% provides a lot of carry in the current market. I think as we go forward into 2024, it's going to be a different type of year in terms of earnings and dispersion across the board in terms of credit selection.
Talk to us more about the earnings picture. What do you foresee, and where do you see areas of weakness? Where do you see areas of strength?
Sure. So as we've gone through 2023, and in particular Q3 earnings, I think surprised to the upside. And that's not surprising as we look back with very strong GDP numbers here in the U.S. I think as we go into 24, we're going to see more differentiation. What we've seen over the last couple of years is normalization as we've dealt with inflation factors, be it supply chain, labor, and just cost of inputs. I think as we go through 2024, and the U.S. consumer is going to play a big part in this, does that start to impact top line? We've had very strong top line for the last couple of years. Margins have been all over the place. But I think, we're going to have, some sort of slowdown in the top line, and the degree to that slowdown is what's going to be most impactful.
Private credit.
Yes.
I knew this was coming.
How do you guys interact with the private credit business?
Right. So we're focused at Pretium almost exclusively on the broadly syndicated market. I think that's...
So you buy loans from banks?
From banks.
So if I would do my Chase Manhattan Bank, I'd syndicate 90% because I don't want to take any risk. I'm in the business of generating fees.
Right.
So I would sell it to you.
Yes.
Nice.
And so private credit's now creating more competition
Yes.
for the likes of JP Morgan. For sponsors, what they're prepared to do is pay up for certainty of execution. And that was very important in 2023 when the broadly syndicated market was, pretty much shut for parts of the year.
Why was it shut?
We've seen substantial outflows and CLO creation, which
Collateralized loan obligations.
Represent about 3/4 of the buying base for broadly syndicated loans, and issuance was slow to start this year. So the private credit market generally costs sponsors about 200 basis points more in terms of,
And why go there? Because I can't get a bank to do it?
Certainty of execution.
Okay.
And I think that started to shift as the broadly syndicated primary markets opened up and is quite strong right now. So I think the sponsors want both markets, and I'd include high yield as well, to be, accessible.
Are you surprised that the banks have allowed that business to walk across the street? I never would have done that.
Yeah, I think they've been surprised as well. So private credit now is comparable in size at $1 trillion plus to high yield in loans. I think the banks are playing catch up in terms of what role they have in that market. Yes.
Private debt was thought to be really pressured as rates were going to rise, but that didn't happen. Walk us through why that didn't happen.
Yeah, so I think that one thing with private debt that we've experienced, or not experienced, but seen over the last few quarters is they're very aggressive in terms of terms. And as rates have risen, and I think some of these companies and multiples that sponsors are paying, they're having a hard time dealing with the increased interest cost. And so we're starting to see, and this I think is scary, and I was also trained at JP Morgan.
Nice.
So
there you go.
goes back to my training days. first lien PIK loans.
Oh boy.
16% first lien PIK. That
Payment in
is,
kind.
yes, is put in place because they don't have the cash flow to service and cash interest. I think setting up for volatility in the future, but as purely a function of where rates sit today.
How do you think the 2024 deal market will be, ergo the kind of the stuff that you guys are going to see coming out of the bank syndication?
Yeah, I think we're going to see a real pickup in primary activity next year. I think the biggest factor this year has just been the gap between buy and sell side multiples. I think that's started to contract. We've started to see M&A pick up. I would expect that to continue next year. And I think as our market continues to remain open and is active, you'll see a resurgence of.
Are you guys at Pretium raising capital now?
Yes.
Yes.
We are raising capital across all products.
And what's the pitch here? Like, what's the reason that you guys
right? So we think that next year we're going to have a lot of dispersion, and that credit selection is going to be a big differentiator among performance. And I think this goes to sector selection and individual name selection. And that's our strong suit. Yes.
So looking at credit, what do you think this tells us about economic growth?
Well, I think as we saw in Q3, earnings were, continued to be strong and actually accelerated from the first half. I actually think the U.S. economy is doing quite well. And that's what we've experienced in pretty broad-based industries.
What would you need to see in the credit space to raise any sort of red flags to you? I mean, it seems like you're not seeing those yet, but what particular indicators would you need to see for then kind of alarms go off in your mind as far as growth stalling out?
Yeah, so what we haven't seen is a deceleration of the top line. And that, to me, is a function of strength in the U.S. consumer. We've seen a deceleration of growth to some degree, but not negative growth year on year or quarter on quarter. I think we'd need to see that in a more broad-based way across consumer-driven sectors, which we haven't seen at all.